Well, the headline is that oil is hitting multi-year lows, and boy, is it ever. Cash Bashutin joins us now from First Avenue Advisory of Raymond James. Great to have you here in person, too, Cash.
Good to see you, Pat.
OPEC, they keep their production flat. It seems like nothing's changed, and yet everything's changed with the price. What do you figure is going on?
Yeah, you know, we see with oil prices falling the way that they're falling today, Pat, and the market is telling us that it's uncertain what the future is in terms of what OPEC is going to do. The question at this point is, are they going to step in at some point and cut production or keep production levels where they are? The announcement today said they're keeping them where they are, and the next meeting is June 5th. So at this point, we have to wait and see if there's any sort of intervention before June 5th.
Okay, and the point is that if they cut production, then there's less supply, and so oil prices would go up, right? Standard supply and demand.
Exactly. There's a whole lot of supply out there right now, more supply than we need, especially with China slowing down. Their economic growth over the last 30 years, Pat, has been about 10.5% per year. Currently, China's growing at 7.5%. So that lost demand combined with the new supply, which is primarily because of the United States with the shale and fracking technologies, you have sort of the perfect storm. Demand has gone down and supply has gone up.
Okay, in Toronto, the oil stocks are getting creamed. What would you do right now?
Yeah, so we've been bearish for 3-4 years now on energy. We feel that with China's economy slowing and the new technology that's online with the United States, we've had more of our portfolio positioned in the United States than Canada. That being said, I don't believe that $69, $70 oil is in line with demand. Our view is oil should be closer to around $75 to $80 a barrel, but you do see it trading at a discount today because of the uncertainty factor that's out there. So if you own energy stocks, today's not the day to be selling. But at the same time, I don't think that there's necessarily a big buying opportunity here either, because like I said, we've been bearish and view that the next 10 years not to be nearly as fruitful in the energy space as the last 10 have been.
A lot of people are saying this is an overshoot. When it gets down below $70, it's an overshoot on the price. But these overshoots have happened in the past, and they can go a long way, can't they?
It's a great point. I think that there is somewhat of an overshoot here. Like I said, I think 75 to 80 is a more appropriate price for oil based on demand and fundamentals and supply. But the question here is, it's at 69 today. There's nothing holding it back from 68 or 65 or even lower, depending on how long we go without any clear direction of if there will be a cut in supply.
You know, it's interesting. I was just in the States, and I was paying for gasoline at a fraction of what I was paying 6 months ago even for gasoline. And they say that for every penny that it drops in the United States, it translates to $1 billion boost to the economy, retail in particular.
Yes.
Here we're heading into American Thanksgiving. We're in the gut of the shopping season.
Yes.
Would you be buying the retailers right now?
Well, we've been fairly bullish or positive on the U.S. consumer as a whole. You know, you look at their debt as a percentage of their income, and not only does the U.S. consumer have less debt than a Canadian consumer, but they have considerably less debt than they did in 2007, right at the peak. So what all of that means is that the U.S. consumer is in a position to spend. The good news is you don't need to encourage the U.S. consumer to spend. They're very good at doing that. And so you can, you know, we talk to friends in the United States, or even when I was last in the U.S., on the weekends, the malls are packed. People are spending money. And so we do feel pretty good about the U.S. consumer. And as a result, we feel pretty good about some U.S. consumers, not all.
Well, okay, so what are you looking at, retailers? Are you looking at the Walmarts, the Targets, the discount brands, or are you looking at the Saks, the high-end? What sector do you think most is the best opportunity?
So look, the consumer is going to be spending money. Yeah. Now, there isn't sort of one sector that we love and one sector that we don't. For example, if you look at the high-end market, you look at brands such as Gucci or Louis Vuitton, they're still quite popular among the consumer. But you look at a brand that was competing with them just a few years ago, such as Coach, and they've really fallen out of favor in terms of their designs and the brand value compared to where it was only a few years ago. So you do need to be selective that although the consumer is spending, they're not spending money on all retailers, and you want to make sure that you're in the right names.
Yeah, well, you got to do your own research on that. Isn't that something? Chris, are you an advocate of the Christmas rally too? I mean, it typically starts now, U.S. Thanksgiving. It seems to be a little bit early, and we're at record highs basically on the Dow Jones and the S&P already. But I mean, can we have more?
Yeah, you know, I think if you're looking at the Canadian market and the U.S. market, again, we like the U.S. market more. A lot of the retailers are there as well. I think the U.S. market has some room here, especially in the second half and late part of the year. Also, when you see the pension funds and some of the large institutional money managers step in and do some buying, so they wrap up the year with some good results.
Yeah.
So I think that it's reasonable to expect some upside from now until the end of the year. But again, the easy money's been made in Canada and the U.S. after 5 years of the market's consistently going up. So now more than ever, you have to be selective about what you buy, and you have to be comfortable with the risk that's in the portfolio, because like I said, the market, now that it's fully valued, is going to be much less patient and immune to bad news that it has been the last few years.
Are you cashing in on some of your wins? Excuse the pun.
Yeah, well, you know, Pat, we built up some cash earlier in the year, around the spring, summertime. We reduced our exposure to equities by 20% across the board. And we did that because we recognized that we've had such good markets for the last several years, and we wanted to be cautious going through the summer. Now, as you know, we had recently a correction in the market. We took that as a buying opportunity and stepped in and did some buying. So right now we're at target asset allocation for each client depending on their objectives, and we're not expecting any sort of major meltdown or correction, but at the same time we're not expecting any sort of big wins either. Our message to clients at this point is expect two things to be different really in 2015. One, expect more turbulence than we've seen over the last few years, and expect the magnitude of returns to not be at the same levels as they have been now that we're later in the recovery.
Okay, so as a result, do you do things like buy dividend stocks to give you a little bit more downside protection?
Yeah, we've always been there. So all of our equity exposure is in dividend-paying companies, because at First Avenue we're conservative. So we own 20 names in Canada, 20 in the U.S. They're all dividend-paying names. But really, I think moving forward, for the average investor, what they should be really doing now is looking at their portfolio and making sure that they understand the risk that they have on their plate and their portfolio, because like I said, the last 4 or 5 years, the only side of risk you've seen is the reward, right? Because markets have gone up. So now that stocks are more fully valued, you want to make sure that although you've been comfortable living with what you own in the good markets, that you're able to stomach what you own in a bad market, or I shouldn't say a bad market, but a time of greater turbulence than what we've experienced.
Okay, and what is your typical allocation between equities and say, well, I'm making a guess, it's equities and bonds, but is that the case?
Yeah, so if an investor doesn't need any income from their portfolio, Pat, for sort of 8 to 10 years, we would be 80-20, 80% in dividend-paying Canadian and American companies and 20% in fixed income bonds and bond-like investments. For a client that's closer to looking at drawing income, we would have a 60-40 mix, 60% in dividend-paying companies and 40% in bond and bond-like investments. But you need to be careful that you know, over the last 30, 40 years, the word bond was synonymous with safety. But knowing that we're at all-time low in interest rates, at some point rates are going to start to rise, and you want to make sure that your bonds are properly positioned as well. So any investor that owns long-term or long maturity type of bonds is in a position to see the value of their bond go down.
Potentially, you could be looking at a double whammy where the bonds go down at the same, because interest rates go up, but interest rates go up, say that the economy's improving.
Yes.
But the equities have already got that factored in.
They do, you know, and I think when you look at the portfolio as an investor, you want to really understand the volatility and what you're willing to live with. I mean, for me, I'd rather buy BCE, Bell Canada, and capture a 4.5–5% dividend instead of buying a 5 or a 10-year bond that's only paying 3–4%. And I would tell you that many bonds at this point are in a position to have to withstand more volatility than some of the dividend-paying stocks that are out there. So again, you want to really look at what you own and make sure that you're comfortable with it in the environment that's coming up.
Well, and that's the thing. Sometimes you can't see the environment. John Deere is an example of that. You know, they make the tractors, the agricultural, everything's been fine for years.
Yes.
Pay out a decent dividend, all those kinds of things. They even meet their earnings forecasts.
Yes.
But then they warn. They say crop prices have gone down. So, you know, that crystal ball can sometimes get a little foggy, can it?
Absolutely, and that speaks to the importance of making sure that you have some diversification in your portfolio, because even the greatest names that have been around for years, pay a dividend, can get into some trouble. And it doesn't mean the company won't be here 2-3 years from now, but it means that they're going to go through a period of turbulence and a decline in the share price. So again, diversification, risk management, all of these factors tend to be less important for investors when everything is going up and it's sunny outside. But again, now more than ever, it's important to look at those components of your portfolio, because we are entering a time where it's not going to be as easy to make money as it's been.
I think you're right, Cash. Thanks so much. Great to see you here in person, too.
You too.
Cash Bashutin joining us. First Avenue Advisory of Raymond James.